our tax planning webinar today. We are happy to see so many people joining us and here to learn a little bit more about tax planning. We've got Scott Wagner and Ed Saney as your panelists today. I will let Scott kick it off, and we will answer any questions at the end of the webinar. So please enjoy.
Hi, everybody. Nice to have you on our tax planning webinar. My name is Scott Wagner. I'm a CPA and CVA and tax manager at Saney Associates. We'll be going over some tax planning ideas and strategies, and also covering a little bit of the new proposed tax laws, which of course are changing by the minute. So we have the updates as of this week, but we'll definitely keep you updated as those change. Ed, do you want to go ahead and introduce yourself to everybody?
Thanks, Scott. Hi, everybody. I'm Ed Saney. I'm the managing partner of Saney & Associates. We, as many of you know, we have 3 offices down in Florida and a couple offices up in Western New York. We do taxes in almost every state, so we're pretty well experienced in all forms of the tax laws, especially with the states. We also have been heavily involved in tax planning. We started mini tax season starting October 1st and go right through December 31st, as we tell all of our clients and prospects that as of January 1, we become historians and we can't help you with that year. So this is one of our beginning initial parts in trying to give you some ideas for year-end planning. We also have, as you can see on the board, there are other organizations that we're associated with or own. Supporting Strategies happens to be a virtual CPA, MBAs doing office management work, controller, CFO for the day, that are in the virtual aspect, which has become more and more important in these last couple of years of COVID. And we have Transworld Business Advisors, which is business brokering, buying and selling companies. It sort of completes the business cycle of your business. If you're in going through your full succession plan, we usually do a lot of strategic planning and succession planning. And if we can't find adequate people inside your organization to take over the company, we've also got that other hat where we can sell the company for you. GLR is a company that we have just as it publishes QuickBooks training guides for colleges, universities, and we're doing webinars on a monthly basis in different niches. We've created some special module niche books for construction, QBO, which is QuickBooks Online, and law firms. We're currently looking in for not-for-profits and manufacturing too for specialization. But we do handle a lot of seminars and webinars with that, and we're tied up a little with the Small Business Development Company Corporation in the United States, which entitles 996 offices throughout the country. Biz Collections is a collection agency where we have in-house attorneys that can help with some of the receivables in your company. And we have also Clear Choice Capital, which has been starting up, and it's really been fending off from the PPP programs and all of our relationships that we've established with the Small Business Administration. And it's financing for companies, reorganizations, buyouts, buy-sells, and all that. So we've got the whole gamut. Again, what we're trying to do now and to get you all hooked on is the tax planning for the year, and we're available anytime during these next few months for any questions you may have from this. Thank you.
Great, thank you, Ed. I'm going to go ahead and give a little presentation overview, and then we'll kind of get into the tax planning ideas for both personal and business side. So we'll definitely be talking about all the proposed legislative changes, some specific ideas for individual and business tax planning, give you an example of one, and then kind of talk about how we can best help you, or of course, answer any questions that you guys have at the end of this. So we do want to dedicate some time at the end to answer questions and see how we can help you today. One thing to note is that you can go ahead and submit questions in the chat box during the presentation. Morgan, who introduced us in the beginning, will be keeping track of all of those, and then we'll go over them at the end. So if you think of something, go ahead and send them now, and then we'll go ahead and address them all at the end. Of course, you can always ask questions at the end too. All right. The first thing we want to talk about is the importance of tax planning. Obviously, I think Ed kind of hit on this in the beginning. We become historians after December 31st. So we want to do it, we typically like to start working with clients right about now, October, November, then we can make any final changes in December, get payroll set up, implement retirement plans, and all that. So it's much better to be proactive rather than reactive. So definitely, we're starting to get lots of tax plans now. So now is definitely the best time to jump on it, especially as all these new legislative changes are starting. We're getting a lot of questions, did tax laws change that much, or do I really need to do it this year? It's a definite yes, especially with like calculating the ERC credits for our small business clients. A lot of small businesses, we're well aware of PPP, but don't really understand what ERC is, which is the employee retention credit. I just did one yesterday for a client, and they're going to be ending up getting about $200,000 back over all 4 quarters. So there's a ton of money on the table there that Congress has put aside as part of all the legislation related to COVID. And then, of course, there's all these new proposed legislation changes. So we're working with clients, should I remain a C Corp? Should I switch to an S Corp? What about estate planning ideas? I heard they're going to make the estate planning limits, from $11 million down to $5 million. So all those questions. Capital gains, should I sell my gains now if the rates are going to go up? Earlier in the year, they proposed that it was going to change as September. I don't think that's going to happen anymore, but it may be as of the date this new law is passed. So it's definitely time to start tax planning now to make sure you can save as much as possible going into next year, especially before the rates go back up, especially on the personal side. Ed, anything you wanted to add to that?
No, I think you've covered most of that. I know what you did mention on that, Scott, about that September 13th clause they have in there for capital gains. And if anybody's doing any kind of contracts now for sales that are going, hopefully trying to sell their businesses or an asset before the end of the year because of this, just to be safe, we've had contracts in place that you may want to make sure are dated before that September 13th deadline. However, what we're seeing in all the research, we're saying right now with Mansion and all that capital gains date is going to be tossed out. So.
Yep, that's true. But we never know what they're going to come up with in these last few minutes. That's why we're watching it every day too. Okay, so let's jump into some, basic business tax planning ideas. Of course, it can get much more complicated from there, and that's our job to sit down and work with you through your tax plan, evaluate the numbers for this year, what's going to happen next year, and kind of take that all into account to see how we can save you the most taxes going forward. One of our basic advices is always, want to make sure if you need any major equipment or vehicles, when we do the tax plan, we'll evaluate which year is going to save you the most money in, because, if you're a little lower this year and you're expecting more income next year, it might make sense to purchase January 1st rather than December 31st, or the other way around. So we'll evaluate the depreciation rules, make sure you qualify for 100% bonus depreciation, and tell you the right timing to save the most money on the tax bracket, especially for our pass-through entities like partnerships and S corps, or Schedule C small sole proprietors. A lot of things we do right now during tax planning is make sure you have the right retirement plan implemented. There's all different types. There's SEP IRAs, there's solo 401ks, there's safe harbors, which you would have needed to have by October 1st. So sometimes it's even better to start tax planning in September if you need a retirement plan. But there's some ways around that, or some testing rules that we can work with you on to make sure you get a retirement plan set up. There's also the profit sharing plans implemented on top of the retirement plans. So we do a lot of calculations with businesses based on compensation planning. We also factor in the qualified business income deduction, which is down there, into the compensation planning. So it gets pretty complex on some of those. Another thing is officers' compensation. We always like to make sure, the officer's compensation is not a red flag to the IRS. And one thing they compare is distributions versus officer compensation on the W-2. So we'll take those into account while maximizing a retirement plan and maximizing qualified business income deduction. So it's a multi-step process there, but I think it's the best way to handle, tax savings for small business clients. Another key thing that I've worked with a lot of clients on, I'm working with one right now, is cash versus accrual methods of counting. So a lot of times we get new clients in and their accrual method, and they don't even know why. So we'll do an evaluation and say, okay, well, if you go from accrual back to cash method, you can save, you'll get an immediate tax savings of sometimes it's a couple $100,000. And that's money in their pocket right now. So it's definitely an evaluation we like to do with all of our new clients and new tax plans, and just see if there's any savings on the table there. There's some more advanced strategies that we like to work with small business clients and the owners of small business clients. They can be restricted property trusts, cash deferred plans, CRUTs, others. Ed, do you want to make any comments on some of those advanced strategies you've been working on? We don't need to get into all the details, but just let people know they're out there.
Yeah, no, I think of the ones you're talking about right now, Scott, would be maybe the cash balance plan and the restricted property trust. The restricted property trust is a way of being able to deduct life insurance on yourself and build a cash value on it, and it's a tax deductible allowance. And the tough thing is it's a $50,000 minimum, and you have to stay in it for at least a 5-year period. But in that 5-year period, it's a heck of a deferral retirement plan for yourself and covering life insurance, which is basically totally deductible. I think in your your other discussion about accrual to cash basis, it's for corporations. It was increased, I think, under the Trump law from 10 million to 25 million. So that would require to relook at a lot of companies where it is beneficial on just being taxed on the income you receive and the checks you write, as opposed to being taxed on big receivables and perhaps a lot of inventory too.
Yeah, it definitely helps in your cash flow when you go to a cash method, because you're lining up cash received to cash is paid to taxes. And on those more advanced strategies, we get a lot of those questions from clients that say, okay, I maxed out my 401k and my retirement. I feel like I'm paying way too much in taxes. It's usually for the higher income earnings. You probably want to look anywhere from the $300,000 to $500,000 in profit range before you implement these tax advantage strategies. But we'll do that as part of a business tax planning evaluation for you. So we'll definitely keep that in mind and want to make sure you can maximize the most amount of savings for your company. This next slide kind of takes us through what a typical software that we use as a printout. So a lot of times we'll throw in what your personal return would look like and walk through the whole thing with your income from a pass-through, which is your S corps or partnerships, any other investment income, and we line it up on a scenario basis. Sometimes we get 4, 5, 6 scenarios out, depending on the complexity of it, especially when you're multiple salaries and qualified business income and retirement plans, and some of those advanced strategies. So we can say, okay, this strategy compared to this strategy, timing, implementation, and then we can actually go down and calculate the actual tax difference. And our tax planning software updates regularly, and if any of these proposed changes go into effect as of like that September 13th date for capital gains or anything like that, it'll automatically be updated, and we can rerun the scenario to see how the new tax laws can affect you. Individual tax planning, I think we've kind of hit on the retirement plans a couple of times, but if you don't have a small business and you're like a normal W-2 employee, we always recommend maxing out your 401k, especially up to the employer match portion. The profit sharing is a business side, so if you have a business side, we recommend and try to optimize the profit sharing portion, which is a deduction to the business. But a lot of times we want to make sure you max that out. Your FSAs, your HSAs. I know in 2021 they did the dependent care FSA to $10,000 instead of 5. Hopefully they extend that as part of the new tax plan, but we'll have to wait and see. So definitely want to make sure you do that. There's also college savings that can add in there. So I know New York for a fact gives additional credits for the 529 if you use a New York plan. The other thing, if you're sitting on a lot of long-term capital gains from stock investments, you can look at qualified opportunity zones. Those provide a good deferral of taxes and a lot of tax savings if you make a right investment for your portfolio. There's other, charitable ideas and other that. So we'll take a look at your individual tax plan with your business tax plan and kind of go through both and see what's there for the most tax savings for you. Some other ideas for individuals is that there is the NOL rule. So if you did have a down year due to COVID in 2020, or even 2021 if it's carried over, we can actually do a carry back to some of your better years and get you an immediate tax refund, which is good. It's called an IRS 1045 form, and that allows us to carry it back and apply for a refund automatically. So I know I'm working on several clients to get that carry back because they need the cash flow now. The good news is most of our small businesses are, if they were impacted by COVID, most of them are back up or close to it to where they were. And that's where really that ERC money really comes in from the employee retention credit, because that definitely helps the cash flow. Offsetting gains is typically what we refer to as with your capital gains and capital losses. So if you have a lot of capital gains, we'll see if you have anything in your portfolio that can offset that. Because normally if you have a capital loss, you're limited to 3,000 per year. So we'd like to see, let's get the gains and the losses in there to even them out and reduce your overall tax bill. And then the lifetime exemption on the estates, we're going to talk a little bit more about that in the proposed legislation. But right now it's 11.7 million. So, we're working on some advanced strategies if you happen to have an estate that large or will have one that large, on getting to use as much of that exemption as possible now before they change it. And I know you've been working on a few clients on that. Do you want to kind of talk about some basic strategies there?
Yeah, if you're up there where this 11.7 could be effective when it's going to go down to $5 million, a lot of people still want that type of capital to be having their own control of. But we've had a lot of people creating trusts for the children as beneficiaries and trustees. It has to be an irrevocable trust, but they have, which we've been involved with heavily now, is irrevocable grantor trusts, where the grantor, which would be you, the person with the money, would have not control over it. They're giving up control, so it's out of your estate, but you'll have use of the funds of the interest, dividends, and capital gains, and you'd be taxed on them. But the corpus of that money would be out of your estate. So if anything happened, or you would be able to use up your exclusion. We're having a lot of people do that. We also have, which is a little unique, but it's creative and acceptable. Some of the people that have that type of money but still don't want to part with it are creating notes to the trust and paying interest on it. And that note to the trust is technically a gift to the trust and using up their lifetime exclusion for it. So and in those trusts, you can put a little, what we call graveside management on those trusts, so you could control the use of those funds, which I still feel for any of our clients that those type of trusts are very protective. They can be credit shelter for those individuals in such a litigious society that we live in today. The trusts are really a pretty good guard against all those legal responsibilities or occurrences that could happen to somebody who's got that money in there.
Yeah, great points. And I think the whole takeaway here is that, if you know anyone or if you're in this situation yourself where you're going to be over the 5 million exemption, one thing to always factor in is what's your business worth too. A lot of people don't realize that their small business is worth a lot of money that could put them over that exemption amount. So there's ideas and there's planning techniques available, is what you need to learn. And we can take it from there once we do our initial consultation with you and recommend the right strategies if needed. So now we kind of wanted to get into the proposed changes that, of course, are changing by the minute in Congress right now, and that's kind of all over the news. These ones were, the key points. I know some of these may have changed over the last day as they're trying to get closer to a final deal. And we'll send an email update out once we have the final plan and it's changed, but it does look like something will probably pass by year end the way they're being aggressive about it in Congress. The one that we're pretty sure will happen is that they're going to increase the top individual rate back to 39.6%. That's what it was historically for quite a long time. So, we'll look at that in your tax planning and see, if you're going to be at that top level, what can we accelerate income this year, and you'll save a couple percentage of tax income right there just from accelerating income into 2021 versus potentially 2022 when it goes up. Long-term capital gains, I know they're probably not going to end up doing this, but they were going to have additional taxes for anything over $1 million on it. So we'll keep watching on that and let you know. Same thing with the unrealized capital gains. They had talk about that. I think they're getting a lot of pushback on that now. So we'll also keep monitoring that. The phase out of the pass-through deduction, which is a qualified business income deduction. I haven't seen any newest updates on that, but that's something we'll have to plan for. And that will, potentially lead to more retirement and more of those aggressive strategies if you're over that amount. So how can we get your taxable income back down below 400,000 so you don't have a tax increase? So that's going to be one of our goals too by using some of these advanced strategies. Same thing with that 3.8% tax. You won't have that if we can get you down below 400,000 by using some of these advanced tax planning strategies. And the long-term capital gains rate from 20 to 25%. That would mean let's go ahead and sell some of our capital gains that make sense to your overall portfolio now, depending on if they increase that or not on this final deal. And any comments on the individual side before we get on to the next slide for businesses?
Well, the other thing is that 20 to 25% capital gain, you might want to couple that when you're thinking of the rate with the line above it, because normally you're going to have that additional 3.8%. So I always say that it's really 23.8 to 28.8 is what the new rates are going to be. So normally with that, and even the other point about capital gains as ordinary income, yes, we don't think it's going to happen with the above the $1 million. They're talking some other things right now, and I don't think that $1 million is going to be there. They're going to try to get an overall across the board rate on the overall capital gains, which is probably going to be at that 28.8%.
Yeah, so we'll definitely keep you updated as a final plan comes out. But these are just things to think about during tax planning and what we can do now, because we know some basic structure of these changes will probably go through by year end. And then proposed tax increases for businesses. There's been a lot of back and forth on this too. This is your standard C corporations, which got the 21% rate a few years ago under the Trump tax plans. They want to bring that back up to 26.5%. And one thing they're talking about on the next line is a 15% minimum corporate tax rate on these large corporations making, billions of dollars that pay zero tax. A lot of people don't realize they're paying zero tax because they have a lot of net operating losses carried forward from, years of loss, like Amazon and Tesla and those big companies. They have lots of losses they can carry forward, which is why they're not paying taxes at the moment. But they want to make sure they have a 15% minimum corporate tax for all these billion-dollar plus companies. And then also for $5 million per year, they want to impose a 3% surtax on that too. So potentially a lot of increases for our C-type corporation businesses, but those are all yet to be determined also. And then we'll get to the estate area, and I'll let Ed jump in a little bit more on this one. But they're, proposing going from our $11.7 million exemption now to a $5 million exemption, which is typically indexed for inflation, so it might bring it to about 6 million total there. But that's, basically cutting it more than half, and the lifetime exemption amount. So we'll see what happens there. I know they're going back and forth on that. Potential to subject unrealized gains at death. Right now, you get a fair market value step up, which is on the next line there. So, I've had a lot of clients that have, got huge tax benefits from the step up in basis. So that could be a potential blow to a lot of people who may be inheriting in property over the next few years here. Ed, do you want to add some more comments on that?
Yeah, we've always been faced with that decision of pauperizing an individual so they don't have to be Medicare dependent, or which would be creating trust to get money away from their estate. But that is the tax basis would be that individual's basis in that stock, or trying to keep it in their estate to wait until death so the beneficiaries can get that step up in basis. Well, that's not going to be a consideration if they do this with this the gains and the not allowing the step up anymore. I think with the exemption amount of the 11.7, the only thing that we've been booking on, I think Scott's probably close that it's going to be reduced, but it's never been reduced before. And I only can recall the one time when Congress increased the exemption from, I think it went from 600,000 to 800,000. It was because the average wealth of a congressman was $800,000. And today it's $10 million. And I'm not sure that they'll go below that $10 million threshold. But again, all we can do is hurry up and wait and at least try to see what this possible $6.7 million that could be at risk, if you can do something about it. I think the only other thing to it, what we've been doing recently is with people at that type of wealth, has also been creating charitable foundations. And we're doing, I think, 8 of them right now, and trying to get them by the end of the year, which the approval is not going to come through with any of them. But we're making appreciated stock transfers to these foundations that they have some extra money out. And there's some favorable tax laws for charitable contributions right now for 20 and 21. And we're putting them into a family charitable foundation where it could go on forever with family members being involved with it. So if it's sizable,
Yeah, I think what Ed was saying there, yeah, there's a lot of opportunities for planning, and if you're in that range, so feel free to reach out to us and we can make sure to do a free evaluation for you. And that's kind of what our next slide gets into. So we're offering, 1 hour tax planning consultation for any new clients that want to, take a look at their tax situation and see if they need tax planning this year. We can almost always find some sort of savings for every client. I mean, it's very rare that we say, no, you don't need any planning. That just almost doesn't happen unless you have just a single W-2 job and that's it. Yeah, we're happy to do that. So feel free to reach out for a planning consultation. You reach out to me, myself directly, or Ed, and we're happy to take any questions that you guys have now too. So if you didn't get a chance to type in your questions, feel free to go ahead and type in your questions to the question box, and we'll start answering them for you. If we don't have any answers, we'll definitely follow up to after the webinar with an email or phone call.
We do have a couple of questions here. The first one is, can you tell me a little bit more about the employee retention credit?
Sure, yeah. So, I mean, the employee retention credit could almost be its own webinar, but earlier or last year, they implemented it in the COVID legislation that allows companies that have payroll to get basically credit back on their payroll for keeping employees retained. That's why they call it the retention credit. So if you had a dip in revenue in 2020 at 50% or greater, or 20% or greater in 2021, and it goes on a quarterly basis on your profit and loss statement, then you can apply for a credit, which is in 2021 equal to 70% of your wages, or in 2020, 50% of the wages. So a lot of planning opportunities. Oh, no problem, Ed. So a lot of planning opportunities come in there, especially you have to factor in the PPP money because you can't double dip into that. So we're doing basically a free initial calculation for a lot of clients right now. I know the one I just did yesterday on a phone call, they're end up going to get about $90,000 a quarter. Granted, they have a lot of high wage earners, so they can max out to $7,000 per employee per credit. So yeah, if you think you've had a 20% decline, you're not sure, and you want us to do a free look at it, we're happy to take a look and estimate what the credit would be, and then help facilitate the amended payroll returns and everything like that. So just let us know.
Thanks, Scott. Next question is, how do I know which retirement plan is best for my company?
So yeah, I briefly touched on the retirement plans earlier. A lot of the small sole proprietor type businesses can either do what's called a solo 401k or a SEP IRA account, which are pretty seamless and easy to implement. Companies with more employees, typically we recommend a safe harbor 401k or a traditional 401k with a profit sharing plan on top of it. So those are the most common plans. There are some different types of plans with different types of testing that are a little more advanced, and we can get into those details when we take a look at your company and overall tax plan.
Perfect. And as for now, that seems to be all of the questions that we have, but I did want to let everybody know I'll be sending everyone that attended today a follow-up email with the PowerPoint presentation, just in case it jogs any additional questions that anybody has. So feel free to respond to my email with questions, or we can set up your consultation with Scott or Ed, or you can reach out directly to either of them with the email that's on the screen right now. But if that is all for the questions today, we really appreciate you taking the time to join us, and look forward to hopefully connecting with each and every one of you after this.
Great. Thank you, everybody. It's been a pleasure.